Hello and welcome to this episode of TNT. Today we're going to update the previous numbers from the inflation video that I put out just a few months ago. I'm doing this as it's necessary. While the numbers in this video are new, the previous video was a deep dive into the how and why inflation is occurring. I still recommend that people watch it as it is filled with knowledge. Now, here's a link above for the original inflation video. In this episode, though, we're going to quickly review a few definitions, a quick review of quantity theory of money, the effects of inflation, and the data associated with what is happening. Now, then to round all this up, we're going to talk briefly about what to do. Let's get started. Inflation is the increase in the overall level of prices measured by the Consumer Price Index or the GDP deflator. Now, there are three other types of inflation that are destructive to economies. Stagflation, which is the period of falling output and rising prices. It's also usually marked by high unemployment. We may be seeing signs of this right now, we will see. Hyperinflation, which is inflation exceeding 50% per month. Hyperinflation is almost always started by governments printing too much money. And deflation, which is the decrease in the overall level of prices. The Great Depression being the most prominent example of a deflationary period. So what causes the value of money? Money supply, money demand, and the intersection at which creates an equilibrium point. This is demonstrated by the quantity theory of money, which states the quantity of money available determines the price level, and the growth rate of that quantity of money available determines the inflation rate. In short, it takes more dollars to buy the same item. Economic principle number 9, straight from the textbooks. Prices rise when the government prints too much money. What is the current inflation and how does it affect me? Well, the effects of inflation can be stated simply that prices rise briskly and any savings that you have becomes worth less, and the more taxes the government makes through the printing of money. So here is the current 12-month Consumer Price Index breakdown with just a few selected categories. This is from August, so all items rose 5.3% year over year. Energy rose 25%, gasoline rose 47.2%, previously over 50% last month. Natural gas rose 21.1%, and food rose 3.7%. All of these items have a direct impact on people's checkbook on a daily basis. We mentioned real estate prices rise during inflation as well. Well, while this is true, the housing market has been marked by high demand and low supply. That said, here are the prices that rose over the last 12 months, and the United States overall increasing by 17.4%. This slide from the previous episode demonstrates trends by using moving averages. In essence, how much did prices change in 1, 2, and 5 years? In May, the numbers were 3%, 4.8%, and 12.2% respectively. But if you fast forward to August of 2021 and we can see the effects of inflation taking hold, the 12-month is at 5.3%, the 2-year is at 6.6%, and the 5-year at 14.0%. This means that the prices for the same goods a year ago are 5.3% more expensive. When we look at the charts side by side, we can see a wave of inflation driving prices higher. Remember that the effects of inflation compound. So what is causing this? Well, it's the massive amount of money being printed by Congress and the government. We can see the general increase in the supply of money since 2007. Note that the general rise you're seeing was increasing the money supply by about 2 to 3% per year. When the economy shut down for the pandemic, this is when this massive spending began. I'll comment on this one in a moment. Taking a closer look at money supply for the last 2 years, we can see inflation taking hold in February and March of this year, when the spending bills were passed by Congress and restrictions on energy production began by the Biden administration. It is reminiscent of the 1970s in many ways. Taking an even closer look, we can see how aggressively the money supply is being increased to pay for the reckless spending of the government, paired with inflation taking hold. So was it necessary to pass the stimulus packages in 2020? Yes. As you can see on this chart, the GDP, or the gross domestic product, fell to almost zero, with the highest levels of unemployment in generations. The packages were established to stabilize the economy for a short-term jolt. However, once the Biden administration got into office, instead of showing restraint, the printing party was on with their massive spending packages. This is compiled with really bad energy policy, which is driving prices higher as Americans adjust to the new norm of remote work and population shifts. In 6 months through July, the money supply was increased by 5.87%, eclipsing all of last year. What do? There are basic hedges against inflation, including real estate, rental properties, gold and silver, commodities, stocks for now, TIPS or Treasury inflation protected securities, and REITs or real estate investment trust. So how does real estate hedge against inflation? Through appreciation in value, increased rental rates, and increased borrowing costs. Here is a map of the rental growth in cities across the U.S., some of them experiencing close to 25% increases in rental rates. The size of the circles are reflecting the population of those areas, and the color is reflecting the increase or decrease in growth. Are you interested in learning more? We work with individuals and groups in investing, and major funds and corporations. If you would like to learn more or discuss your situation, please contact us by phone or email. You can also fill out the web form in the link to our website below. By the way, how has inflation affected you? I look forward to your comments below, and we'll see you again on the next TNT.